Welcome to Scaling with People, your weekly playbook for turning chaos into compounding growth. Each week, we go under the hood with battle-tested experts in all areas of business, from marketing to sales, operation, finance, and people, plus product and leadership, to unpack the plays, numbers, and systems that turn chaos into compounding growth. Learn straight from founders and experts who've done it and continue to do it successfully. There's zero fluff, just moves that you can steal immediately. This podcast is brought to you by Guide to HR, human expertise, AI-powered impact. Welcome, everyone, to today's Scaling with People podcast. I'm Guinevere Curry, your host and founder and CEO to Guide to HR. Okay, today on Scaling with People, we're rewiring venture capital with Sherwood, Woodie, Neiss, co-founder of Crowdfunding Capital Advisors and a key architect behind the Jobs Act crowdfunding rules. If you don't know about that, you got to look into that. We might talk a little bit about it. We won't get too technical, though. We'll unpack the D3VC, which is a data-driven, founder-first model that fuses crowdfunding signals with smart capital, and then flip the script on growth by turning customers into investors. Yes, we just made up a new word, or maybe Woodie did earlier, but there you go. And they'll stick and spend and evangelize for you and your growth. And because Woodie's Declare database tracks over 10,000 campaigns, we're ripping out the real playbook, what actually predicts funding, velocity, loyalty, and scale, so you can steal the moves and sprint ahead. I'm super excited to dive into this. Welcome, Woodie. So happy to have you on the call. Tell the audience a little bit about yourself.
So I started my career on Wall Street, on the trading floor for PingWeber. I went to Silicon Valley and went to work for a startup there called PeopleSoft. They were a venture-funded startup, and I learned everything about what VCs are looking for in hyper-growth companies. And I worked for them for a few years before I left and started my own healthcare company called Flavor RX. We flavored medicines for children so they're more compliant. Every time a mother got her child to take the medicine, I would get a phone call. And she would say, "How do I invest in your company?" And I would say, "I wish you could, but you can't because we have these laws that are meant to protect investors." And I always thought, wow, what a missed opportunity. Like if I could turn hundreds or thousands of these mothers into investors, they would be doing marketing, bringing in sales. It would be, a dream come true for us. But that couldn't be possible. So we ended up growing and selling FlavorX to a private equity group. And after we sold it, I thought, now I'm in Washington, now's the time. We had the financial, in 2008, we had the great, what was that? Great recession. And so I said, Washington's looking for jobs. I know how I created jobs, and I probably could have created a lot more if we didn't sell it and we went public. So I said to two friends of mine, let's create a framework like Reg D, which is how typical companies raise capital from investors, but it'll allow our friends and family to become involved. So we wrote a framework that would allow startups to raise up to $5 million a year from their friends and family. You don't have to be rich. You can be rich. You have to do it on platforms that are registered with the SEC. You have to have business plans, use of proceeds, all the information that investors need to make an informed decision, your financials, your valuation. But then you pitch it like you would, this was like pre-Kickstarter and Indiegogo. And so we were learning from what they were doing right. And like, we can do similar campaigns, but for companies. And you do debt and equity instead of donation rewards. And so this law really shifted that type of crowdfunding from donation rewards to debt and equity. And now this industry is huge. It's been around for almost a decade. There's been 8,400 companies that have raised $3 billion in 2,300 cities across the United States. Women and minorities represent up to 50% of the issuers right now. They're the ones that are most sidelines by venture capital. And it's just been really transformative. So we built a database that collects information on all the companies. We do reporting on all that information, much like Bloomberg does and their analysis. But we also thought, since we have all the data, why don't we profit off of it? And so we built an algorithm by partnering with some PhDs. And we get signals of companies that are most likely to go on for a follow-on round of financing. And we do what VCs do. We diligence those companies and we invest in what we think are the best ones. And we've been doing that for a year now, and that's D3VC. So we've got, Crowdfund Capital Advisors, we've got C-Clear, which is our data, and we got D3VC, which is our venture fund.
That's awesome. So is this kind of like, how is this different than angel investors, or is it kind of the same?
That's a great question. So it is kind of the same in the sense that you are targeting people that have money to invest in your business. The thing that makes it different is many people probably that are listening to this podcast right now are like, I have a great idea. I've started a business. We're making some money. So I've proven like the hard things. I don't know rich people. Who are these VCs? Who,
Yeah.
angel investors, depending on where you live, you can be surrounded by them. But, also most people don't live in Silicon Valley or New York City and they don't have access to these. And so angel investing is, raising capital from people that are accredited, that are wealthy. But it requires that you know them. This changes the dynamics in the sense that you don't have to know any of the rich people. You can have a Rolodex of people that you do know, and you can't crowdfund without a crowd. So I'll tell people right off the bat that don't try and launch a campaign thinking it's a fishing expedition and just people throw you cash. It doesn't work that way. This is a marketing expedition for people that have a close relationship with you and have other friends. Hey, maybe some of those other friends are accredited investors, angel investors, venture capital. That's where we want to go with this. But we are sort of pre-angel. So we are allowing
Okay.
our friends and family to invest in our businesses.
Great. Okay. Thank you for that explanation. I thought it would be a little bit different. So let's actually say, in one sentence, what's broken about traditional VC, and how does your D3 VC fix it for founders?
So much has changed in the venture capital world. Back in, the early 2000s, it was very different. It was very hard. It's always been very hard to get venture capital money. Only, 1 or 2% of companies get it. You've got to be very, unique in what you do and have a cash flowing business. They can see this huge exit potential. Most companies aren't always going to fit that model. That doesn't mean that they're not invest worthy. And so what we did with D3 VC is we saw, venture capital, particularly after the collapse of the financial markets, or the private capital markets, I should say, in 2022, Silicon Valley collapse, we had hyperinflation. VCs went to the sidelines. They moved upstream. They're like, we're going to invest in bigger companies, less risky, created this whole void. So there's been this void in the whole startup ecosystem where people are like, where do I get capital? We solve for that with this law. We solve for it with the whole industry that allows people to access capital. D3 VC layers on top of that saying, listen, we are going to be the stepping stone for you to get that angel or venture capital by being ourselves a venture capital firm. That's the first VC to put money into your business. So the problem with a lot of these companies, really the future unicorns that are out there going, hey, look at me. They can't get the attention. Okay, you can't send an email to anyone and get a response today. Try picking up a phone call. No one's picking up their phones either. So you need to have the proof. And so what D3 VC does is we look at the data. And if you've got a group of people that are backing your offering, and we see on a daily basis the number of checks that are being written and the total amount of those checks, PS, that's a huge signal in the private capital markets that never existed before. We call that investor sentiment. It is transformative in how these companies are going to grow because the companies that have a huge following, something's going on. And think of it from the point of view of, you know, influencers coming into these companies. So you've probably seen the Labubu doll or the viral Dubai chocolate, and everybody's talking it about social media. There's going to be this evolution in the private capital markets where we operate, where instead of influencers, you're going to have influestors. These are investors in these companies that look like you and me that are on social media saying, I just invested in the coolest company. I know the CEO, the company's doing X, Y, and Z. You guys should check them out. And it's going to transform it. And so D3 VC sort of is that conduit to that, the funding that they will need. And we are going to go to the VCs and we're going to tell them, listen, these are the companies we invested in. This is their social proof. This is how much they've raised. By the way, you're not going to get a follow-on round of financing if you don't hit milestones. So we're just going to highlight all the milestones these companies are hitting along the way and be like, you can choose from all of them, or you invest in all of them. But we are going to deliver to VCs. And VCs, I don't think are going to come back. Like this whole, when markets change and evolve, we don't go back to the way things were. Things change. So venture capital will always be there. They're going to go upstream and work on bigger deals. It's created this opportunity for D3 VC come in. We're looking at the data. We're looking at you as, issuers in the space, and we're investing in them.
I love that. And I do agree, like everything continues to evolve and innovate, and there will be changes for sure on how companies are able to get funding and what that looks like for them. So I'd love to know, you're talking a lot about data, and I'm a very data-driven person myself. What are the top 3 signals you watch before you ever meet a founder? Is it like retention, community velocity, pre-commitment interest? We kind of talked about all of those earlier. What one is the most predictive in your mind, or that you've seen consistently over time?
Well, we already talked about the investor sentiment, and that's, the key
Yeah.
drivers. And then we also look at, your financials and what's going on with your income growth, your earnings growth. Or the earnings growth we don't expect to be the same because startups usually are burning through cash, but we want to see revenue growth, definitely. That's one of the key things. And then we sort of want to look at, what's happening with valuation. Valuation is huge, huge thing that people just do not hit the mark on. There was a time where we all had this, $5 million is what you went out with. And you were lucky if you were price your company that way. And then VC started throwing all this cash on all these startups, and everyone's went,
Oh, that was such a great time, wasn't it? You could get like $20 for a penny.
Right. I should have raised capital then. But
Yeah.
and so there was cash flowing and valuations were crazy and they were super high. We're now going back to what I call this lean startup methodology, which is companies are raising money in smaller rounds. They're doing it at lower valuations that are more realistic. And they're hitting milestones and then going out for follow-on round at a higher valuation. You need to make sure that your valuation in your industry at your revenue stages and age of growth match who you are. We built a tool called the Offering Insight report that allows people to actually, so when you file with the SEC to raise money for regulation crowdfunding, it's a Form C. It's like a template of 50 different data fields. We built an entire system around that and said, fill out a fake Form C. We'll run it through the database with those 10,000 offerings, and we will tell you how much you can expect to raise, what platform's right for you, how many investors you should be targeting for your raise, and what your valuation range should be. Because if your valuation is out of that range, let me tell you one thing. The really smart investors are going to look at the deal and go pass. They're not even going to look at the deal. And I'll tell you an example. There's a beverage company that was online and raising money, and they had a $115 million valuation, and they rose in our algorithm as a company that had a lot of backers and were raising a good amount of money. And I was like, well, let's totally check them out. And then
Yeah.
immediately went to the revenue, and it was $1 million. And I went, how do you get a $115 million valuation on $1 million in revenue?
For $1 million.
And so I was, we passed on the deal. And I feel bad for those investors that are investing at that because I don't think they understand that the beverage market, as we all know, is just a massively populated marketplace, very competitive. And so the chances of you being acquired in that space, IPOs don't happen really in beverages, but it's small. So, look at the velocity of people, look at the financials, look at the valuation.
I love that. And I love the tool that you've built because, I truly do believe that knowledge is power. And if you have this understanding of where you are and where you're trying to go with this sentiment of all these other use cases that you have in your database, that will really help the founder understand what is achievable and maybe a little stretch, right? We always want to stretch beyond and not set themselves up for failure of like, oh, I'm 1 million revenue. My evaluation is going to be 20. Like that's not realistic anymore. We're not in the early 20s and late teens of the
Right.
2000s, right? So
Right.
I think that is such a powerful tool for sure. So let me ask this question. Blind spots. Where does a data first approach get fooled and how do you correct for it?
That's a great question. Data is what I love about data is it doesn't lie. Algorithms, so we built this machine learning algorithm that is AI driven. Okay. So we've got these LLMs that are looking at the data. We've got machine learning that learns from the data, but you have to constantly stay on top of it because you have to make sure that it's not sort of hallucinating outside of these parameters that you set. And so that's where you can have all these algorithms that you want, but at the end of the day, the algorithm's only as good as the data that you put into it. And while we have a 100% complete data set, what we find is the algorithms tend to really positively score things. So what we do is that's where we step aside and be like, you know what? The algorithm gave us this list. But now it's time for us to use our human diligence. We need to look at it from our point of view, where our critical thinking comes in. And so we look at these deals and then we step away from the data, believe it or not. We go, okay, who are you as a CEO running this business? What background do you have? What background in startups do you have? Have you scaled a business before? Have you had an exit? Tell me about your experience in this industry. And then we're like, okay, so you got this great product or service. How have you protected it? So we want to go into the IP that you've created. Okay, so the data is great at looking numbers and quantitative, but there's a whole qualitative side of things that really takes a human side. And so the algorithm is great at feeding us the signals that we want to look at for the companies that we think are going to scale. Then we go and meet with the companies and we do what VCs do. We like meet the team, find out about technology, really talk about their total addressable market. Can you scale with the capital you're going to raise through crowdfunding? $5 million is the maximum you can raise. Most companies don't do that. The median company is raising about 750,000 right now. So if, you've got some lofty goals, what are you going to do with 750? Are you going to fall short if you don't raise more than that? And that's where you have to dig in.
Yeah, for sure. Because if you do have those lofty goals, that 750 is gone in a blink of an eye.
Exactly.
Yeah, for sure. And I love that you talked about the people side. I think when people are investing in companies, it's not just the product, right? They're investing in you as the founder, your leadership team, your team members. So having that soft touch to interact and engage with those people is pretty precious in my mind. Of course, that's my human resources hat, I guess you could say, right? But people are super critical in every business that we run. So I'd love to flip the script a little bit. I kind of teased this new word that you created, investorum. Am I saying that right? Investorum. Yes. Investorers. There we go. So define what this means and what should and shouldn't it do for a founder?
So investors are literally customers that have turned investors. What we're trying to get across to people is the future of finance is merging the principles of social media with Internet 3.0 with the private capital markets. And you have to look at the people that are engaged in your business, not just as customers, but as potential funders. And you have to go to them with the story like, listen, you bought the product or service. Clearly, you like what we're doing. If you believe in us as a company and me as an entrepreneur, why don't you become an investor in it? And the reason why you want to turn to your customers as investors is they will have a really dedicated interest in the outcome of your business. When we invest in, the public markets, Apple or, Disney or whatever, because we love Disney, it's a passive investment. When you're investing in these private companies, these people are actively out there talking to their friends about it, bringing in sales. VCs are great at giving you big checks and then they'll tell you to do marketing, but that marketing is not the same as mouth to mouth type of marketing. Viral type of marketing, as we've seen through social media, is the future. So you need to bring these customers in, turn them into agents for your business. They will do the marketing for it and bring it in. And the beauty about this is you are helping yourself raise capital for a business that is going to hopefully create, wealth for your family, but you're sharing that wealth with your community. And that could be the people that live right around you, the community that you've built around your business, it's just community in general. And there's something powerful in wealth creation that way. But the other thing that it does is all of these businesses that are located in all these little cities all around the United States are raising money. And you know what they do with that money? They hire people. They buy products or services that they need for the business. Something breaks. They need an AC repairman to come in and fix the AC. All of this pumps money into the local economy. The multiplier effect for the companies that raise money through investment crowdfunding can be as high as 20x, meaning every dollar that's invested in a business multiplies 20 times around a community. So this is great for job creation. Like economic development offices should be jumping all over this, saying, what do we need to do to get this going in our backyard so we can have more money flowing in our communities? I think that's one of the key
Yeah.
things. And Investimers is all about that. This book is like my brain on the whole industry. It's 400 pages. We
Ooh,
worked with the World Bank, and so I took all of that information and I put it in the book so everyone can see like the economic rationale for it, how you as a business owner can use it to benefit, and just why this is good for society.
yeah, yeah. I think when you're talking about like that word of mouth, and social media is such a big player now in it, and we talked about influencers earlier. Like I think of, and not to date myself or even this podcast at some point, but if you recall, the guy who was basically holding on to a truck and skateboarding, drinking his ocean cranberry juice, right? And that got so viral that they ended up buying, Ocean Spray ended up buying him a truck and, gave him a check and totally changed his life. But it also changed, I think it probably had a pretty good positive, difference in their net bottom of profitability for them just by someone showcasing how they got to work.
Oh yeah. I mean, what I love about this is the private capital markets and venture capital has really kept, wealth within the rich, which is fine.
Yeah.
I've got nothing against that. They're the ones taking the risks and putting the money into the companies. They get the benefit. We've now flipped the script and allow anyone to become an investor. One of these companies, Boxable. They create these prefabricated casitas. They started their first fundraising
Ooh,
journey. Yeah, it's pretty cool. Like you could do, like I have these visions of retiring and just opening like a glam camp with 20 of them. But they
that's
started their
awesome.
fundraising journey online through regulation crowdfunding at a $24 million valuation. They've grown so fast, they're not even doing crowdfunding offerings, they're doing Reg A. But their current valuation is about $3.2 billion. So if
Wow.
you had invested $10,000, which would have been a big bet in it, and so you don't
Yeah.
have to do 10,000, but if you did 10,000, that would be worth over $2 million today. And this industry,
Amazing.
remember, is not even 10 years old. So I love the fact that this is going to create a lot of millionaires. This is going to
Yeah.
democratize access to capital and democratize wealth. So people that are listening to this can be like, I can use this to raise money. I can use it to help create wealth for people in my community.
Yeah. And I love, like you said, it democratizes it. It makes it so it's a fair game for everybody. And as we know, if you in the past haven't been a rich white male person, generally speaking, you weren't going to have access to this. So I love that. Let me ask on the flip side, what shouldn't this do? And what red flags where turning your customer into an investor has backfired if you have a scenario like that in mind, you could share.
So a couple things there, and that's again, another really good question. One, this is a time-intensive exercise. So raising
Yeah.
money is never an easy thing. And you need to budget for the fact that if you're going to be doing this, consider this a second full-time job. So
Yes. That's what I have definitely seen for CEOs and CFOs fundraising. Yeah.
exactly. Like this is not quick. There's no get rich quick. And so you need to budget for the time. You need to have the resources, meaning other people that can help you with the campaign itself, the video you have to put together, the financials you have to put together, the offering documents themselves. You need lawyers. So budget for that. People that don't take that seriously fail because
Hmm.
here's the thing. When you're reviewing these offerings, you have all the disclosures, all the different documents I just spoke about. Now, someone might not be sophisticated and be like, okay, I see that they completed it. Good. I'm just going to invest. There's going to be a lot of people looking at these deals going, how did you even come up with those numbers? And they're going to question you as an entrepreneur and how your thought process in that. And it happens on these public pages in the comment section. So you need to be able to defend, and in a very polite way, not offend, your what, why you did things. And so people that aren't communicative fail. Because if you put an offering up there and you don't say anything, you know what that means when someone says a question? They're going to be sitting there going, and by the way, at D3VC for the venture fund, we ask questions. The first thing we do is if we're interested, we go over it. We're like, what's a series of questions we want to ask? Then we ask the question. If we don't get a response, that to me indicates you as an entrepreneur will not even respond to me when you get my money. So I don't even want to give you a check in
Yeah.
the first place.
No
Like
kidding.
the worst thing you could do is not respond to a question when you're raising capital. Okay. So,
Right.
there's so many things,
Babysit that sucker completely, right?
yeah, yeah. So, I mean, be the person that you want people to be for you. So you
Yeah.
want people to ask you fair and questions, and you want to be timely in your responses to them.
Yeah, that makes sense. I appreciate that. And another question before we move on here is, what is in this crowdsourcing? You talked about up to 5 million. Typically, it's around 750,000. So, are we talking about like your next door neighbor giving you a $500 check? Like, is there a minimum? Like, what's kind of like the average investment per investor on a crowdsource or crowd vendor? I don't.
Crowdfunding. Yeah,
Yes.
again, great question. You will be your community of backers, which we call investors, in your business is going to range. There's going to be a range. People will be able to, I can support you at $100. Usually we see a minimum of 100. Some of the platforms as low as 10. Um,
Oh, wow.
but you think about you need quite a few $10 investors. Um,
Yeah.
but
You need
what
quite a few $100 investors.
Exactly, yeah. But what we've seen over time is the average check, what started out in 2016 at about $1,000. And now it's a little over $2,000. So people are writing bigger checks. The profile of the companies, by the way, has changed dramatically too. When the industry started, 65% of the companies were startups less than 3 years old that were pre-revenue. Now, 65% of the companies coming in are over 3 years old, so they're established, less risky, and they have revenues of over $1 million. So, you people are putting more money in because it's very hard to put a company out of business that's been around for 5 years. There's all these data points that talk about this. If you're producing revenue, then you're already doing something right. So people are willing to risk more capital in companies that are older and have more revenue. That's how way public markets operate too, by the way. So there's logic that just
Yeah.
flows back and forth.
So that's a question that I have follow up there is there, if you have $1,500 check versus a similar company that has 50, $10,000 checks, you've made the same amount of money, but does that data say something positive or negative or not for your next fundraise and how your business is growing?
I mean, it all depends. If you have raised, that money from 1,000 investors, what I would tell, venture angels that might be interested in this is look, these people see something in us that you don't see yet. So why don't you talk to those 1,000 people? We can get a subset of them and do some research. This is the way venture works anyway. They're going to want to talk to the people that invested. They go, why did you invest? And then the same is true for the deal that only raises, the same amount of money, but from 10 or 20 investors. Clearly, they see something very differently, and wrote much bigger checks. So again, it's all about the conversation that you have with those individuals on what did you see in this company? Why did you write such a big check? Both conversations are going to tell you two different things. One is probably going to tell you what's so intriguing about the company that will get a broader audience. Like I really believe in I really believe in the company that's raised from 1,000 investors because I think if you can do it from 1,000 investors, those 1,000 investors can bring in 10,000 customers. So I really
Yeah.
like that side. Now, the company that raised from 10 or 20 investors, I'm thinking, well, strategically, they see some sort of exit here that is really something we should be focused on. So, from my point of view, I'm investing in both.
I love that. I love that. So there's so many questions I want to ask, but we're getting close to time. And before we sign off, you are also a founder. I would love to put you on the hot seat and ask you what's a lesson learned that you would share with the audience so maybe they could sideswipe that lesson and not fail in that area.
Stop listening to the naysayers. It is so, our brains are conditioned to absorb negativity and
Yes.
just to rationalize with, well, that was negative. I should really take that into consideration. Oh my God, I gotta believe that. Stop it.
It's guys under feedback, right?
Right.
Oh, well, we have to grow. We need to have that negative feedback to grow. Well, no, you could have like healthy feedback, constructive feedback, right?
Right. So don't consider what they're doing and then pull out what you need from that to move ahead. But don't let it drive how you feel about yourself, how you feel about your business prospects. You believe in yourself, and that is the most important thing. All of us as entrepreneurs, we have to be our own champions because we have taken on the biggest challenge, which is building something, and we don't want to let ourselves down. So don't let the world tear you down. Don't let yourself tear you down. Be your own champion. And I know it's so hard. Trust me, I have bad days. I have plenty of them. But at the end of the day, I also know that that bad day gets put in a little box and it goes behind me and it's disappeared. And then I wake up the next morning and I have a new day. It's really important to keep that sort of, realization there and try and stay your own champion and focused.
I think that's such great feedback, especially in regards to when you are fundraising. It can be a lot of naysayers or get kind of in the weeds where you feel like you start double guessing or second guessing yourself. And all of a sudden now maybe you're not saying the things that you need to actually get the investors on your side. So great, great advice. Woodie, I appreciate your time. And for our listeners, I hope you got some good tidbits out of this. We will put Woodie's contact information and his book in our description so you can reach out to him if you have additional questions or want to start working with him. Thank you, Woodie, so much for your time.
Thank you. It was great to be here. I appreciate it.
All right. See everyone later on the next podcast. Have a good one until then.
That's a wrap for today's episode of Scaling with People. If you got value from this conversation, do me a favor, share it with someone building something big. And hey, I'd love to hear your take. Drop a comment, shoot me a message, or start a conversation. And don't forget to subscribe so you never miss the bold, unfiltered strategies we drop every week. I'm Guinevere Query, founder and CEO of Guide to HR, where we help high-growth companies scale smart with people-first strategies and AI-powered systems that don't just keep up, they lead. If you're building fast and want your HR to move faster, head to guidetohr.com and let's talk. And remember, scale isn't just about speed, it's about people. Until next time, have a great one.